Last week, headlines were loud. $588 million flowed into spot Bitcoin ETFs in just 2 days. BlackRock's IBIT and Fidelity's FBTC both saw massive creation volume. But on-chain? Silence. No matching spikes in exchange outflows. No clear cold wallet allocations. No visible market squeeze. So the question is, where is the Bitcoin? And more importantly, is this a bullish signal or a manufactured illusion?
Welcome to Crypto Alpha Edge, your daily crypto market recap 2025. Today's briefing is structured across key themes to help you stay informed and ahead of the market.
ETF mechanics. What flows really mean? Let's decode the structure. When we hear $500 million inflows, it doesn't always mean someone bought $500 million worth of Bitcoin yesterday. Here's why. ETF inflows are often internal, transferred via creation units, or fulfilled by authorized participants who already hold BTC off exchange. These units can be seeded with previously purchased Bitcoin, sometimes acquired weeks or months earlier, and quietly parked in custody solutions like Coinbase Prime or BitGo. So the inflow number reflects share creation, not necessarily new market demand. That's why traders need to filter what's real and what's just a portfolio reshuffle. On-chain reality check. Let's cross-reference the blockchain. According to Glassnode, there's been no significant spike in BTC moving from exchanges to ETF custodians in the past week. Coinbase, which holds BlackRock's ETF allocation, shows stable or even declining net flows. Arkham intelligence also shows that key wallets linked to ETF providers haven't absorbed hundreds of millions in new BTC recently. So again, if $588 million entered these funds, why didn't the blockchain flinch? The market reaction, or lack of it. Let's look at price. While the ETF flows hit the news, Bitcoin traded sideways between $103,000 and $106,000. There was no squeeze, no breakout, no sudden volume expansion. Funding rates across major derivatives platforms remained neutral. Open interest didn't surge. It actually rotated from longs to shorts during the news wave. Translation: the market didn't believe it. Professional traders saw through the signal, or rather, saw the lack of signal on-chain. How inflows can be misleading. This isn't a bug. It's how the ETF ecosystem works. But it opens the door to narrative manipulation. Let's say a fund manager already holds $500 million in BTC. They decide to seed their ETF product by transferring that BTC into trust. Suddenly, media headlines read, "Record inflows into Bitcoin ETF." But no new BTC is purchased. No new fiat enters the crypto economy. No one is bidding the spot market, yet the perception, bullish. Retail enters expecting a move that never comes. That's the power and danger of misunderstood ETF data, whale behavior. Tracking real movement. Now let's contrast that with real smart money behavior. Arkham shows minimal whale accumulation this week. In fact, several known OTC desks are offloading at recent highs. Glassnode confirms this via spent output data. Long-term holders are taking profit, not buying. So if ETF flows were so bullish, why aren't the largest wallets following through? Answer: because they see through the game. And right now, that game is paper rotation, not organic buying. Funding, OI, and sentiment. Let's layer in derivatives. CoinGlass shows funding rates oscillating slightly negative across Bybit, Binance, and Deribit. No strong conviction on long bias. Heat maps suggest major liquidity is still stacked around $100,000, $1,000, and $107,000. Not broken yet. Traders are waiting, not chasing. This is consistent with compression, not breakout. So again, the message: ETF inflows alone don't shift sentiment. What does? Price reaction, spot absorption, on-chain confirmations, the illusion of liquidity. One more factor: timing. These ETF inflows coincided with post-halving supply tightening. With new issuance down, any major demand should push price quickly. But if the price stays flat, despite the demand, it means the inflows aren't real in the way traders expect. This is a key lesson. Liquidity doesn't mean buying pressure. Just because Bitcoin moves into a fund doesn't mean someone bought it today. Strategic takeaway: don't trade headlines. So what should smart traders do? First, filter ETF data. Look not at flows, but impact. Did the blockchain move? Did the order books shift? Was there a funding spike? Second, monitor divergence. If ETF flows rise, but whales remain flat, it's a warning sign. Price may be reacting to perception, not real capital. Third, track real demand. Use Arkham, Glassnode, and CoinGlass to follow the money, not press releases. ETF flows are not a lie, but they're not always the truth either. In this market, perception is a weapon, but data is a shield. Don't trade the noise, decode the signals, and stay ahead of the narrative.
This has been your daily institutional-grade crypto briefing from Crypto Alpha Edge. Stay sharp, stay early, stay informed.